why that team is available, 24/5, why they monitor every single trade and make sure the execution is there. It's because there are unexpected things that happen in the market. Maybe another war breaks out. Maybe there's another assassination attempt on Donald Trump or something like that, which can affect the markets, and they need to be there to control it. And if they don't control it, sometimes things will get out of control because the liquidity provider essentially is 100% control in the execution, and we need to be in constant communication with them to make sure they're not they're not doing something wrong, or the spreads shouldn't be so high. Sometimes they might go high, they shouldn't be so high, and we will negotiate with them to put them back down, or we might need to switch between different pricing feeds to ensure that the aggregator is giving us the best feed or whatever it is. So with that being said, the way I would like to start this Zoom is by asking questions to Andres to answer specifically for you based on what I understand your let's say what you guys want to know. And the differences and whatever you experience are going to be very minute. They're not going to be big issues. However, it is quite normal, and I just want that to be clear. So this is why Andreas is on today, 25 minutes before the American market open. He will be busy, but I just want him to kind of briefly explain, Andreas, if you can, how you guys operate when it comes to A-book different liquidity providers, why you guys work on a 24-hour basis. It may be in a better detailed explanation than what I did, which was brief, from your perspective, because you're the one actually living that life, right? You're the one actually doing that every day.
Yes. First of all, good afternoon, good evening, and good morning. I'm guessing it's all time frames. In order for us to understand, first of all, what occurred with Dan and how we're going to move forward on executing perfectly, we need to understand the context, okay, which is very, very important. So at the moment, Dan has $2.5 million into LPs. So basically, we diversified multiple flow to multiple liquidity providers. Now, it's very important to understand a few things. When Dan opens a position, that means all of the followers, and we're not talking about the followers that are on now, we're talking about more than 600 or 700 followers. So they will follow exactly the trade of Dan, and that will occur based on the leverage. All right, it's very important. So how it works with the liquidity providers. So let's say I'm going to try and do it at layman terms so we can understand. So a liquidity provider, because we are using two bridges, 1-0 bridge and PrimeXM bridge, which is the most sophisticated infrastructure when it comes to bridging and aggregation. Okay, so we have liquidity providers that give us top of book. Top of book is that, let's say, for example, the price of gold is 2,000. I'm just going to make it as simple as possible. So the liquidity provider, when I open a position, in this case, it will be Dan, will give me 100 lots on 2,000 price. Now, if I put 101 lots, immediately it will go to the next available price. The next available price, it can be 99, 98, 97, 96. What we do, we use an aggregation through other liquidity providers in order for us to get the best available price at that particular time. Okay, so when Dan opens a position, it doesn't open 1 lot or 2 lots or 3 lots or 4 lots. We're talking about 600 to 700 lots simultaneously. And it's not one lot, it's like 0.10, 0.20, 0.30. So you can understand, if you put in perspective, it would be impossible not to have tiny slippage. But sometimes, for example, like today, it can have positive slippage also. It all depends on how aggressively Dan will participate on the trade, because normally Dan operates and trades on Asia to London session, which unfortunately at that particular moment, the market is not as liquid as is in the US session. So to make it, this is the context. Now, what we do to be able to facilitate this into a better manner. At that particular moment, I would like to emphasize that we were discussing with Dan okay, to basically wait until we connect to other liquidity providers, which we have successfully connected through this weekend. So we can basically diversify to multiple ones. We don't want to have 1, 2, 3. We want to have 6 or 7 liquidity providers. And we want to do it based on, let's say, this liquidity provider with 10,000 and above would take this one. 1,000 and above would take this one. So this way, when you differentiate it based on the capital, it will be easy for the bridge and the aggregation to work accordingly, and the liquidity providers also to give us the top of the book to be able to participate a successful trade, A, and B, to have a perfect execution. I would like to emphasize there's no such thing as perfect execution, but we are closest to 100% that we have ever been. And I'm sure some can realize from today's trading of done. And going forward, we will be able to see even better execution or more consistent execution. Now,
Andreas, can I just jump in very quickly? Because obviously there's an operational side to this as well, and there's a compliance side to this. So I just want everyone to understand that when we introduce new liquidity providers, it can be quite a lengthy process. Not too long, but we do have to go through an onboarding process, which requires certain documentation or KYC or certified documentation from the company in order to be approved, because don't forget that we are regulated. Therefore, when we work with liquidity providers, they also have to be regulated, and therefore our onboarding process and their onboarding process will be a little bit not complicated, but obviously there's a lot of compliance that comes with it. The other thing I just want to say is that we are connected to multiple liquidity providers. The week in which people did experience slippage, when we looked at the slippage, it was obviously from our perspective, just being from the industry, was totally normal, but maybe for people that are not from the industry would see this as not normal. So that, you know, we kind of explained that to Sahil to be able to deliver back to you guys. But at the same time, we want to make sure that, you know, you get to see Andreas talk about it and also get a better understanding of how liquidity works. And we're constantly looking and connecting to new liquidity providers. We have 9 that we're kind of working towards. We have about 6 or 7 now, and we should have 9 by maybe December or January. And it will be a constant process. It's a never-ending process. Sorry, Andreas, carry on.
Yes, because you mentioned multiple liquidity providers, it's very important to understand that if you add multiple liquidity providers, that means each liquidity provider doesn't send the same price at a particular moment. So
Correct.
what we try to do using 2 aggregated bridge is to get the best available price. But again, I really emphasize on this because we need to see which liquidity provider provides us the lots that we request. Correct? I mean, if I want to get 200 lots on the gold price of 2,000, it doesn't mean that liquidity provider is going to fill me 200 lots. It's very important to understand that, how the industry works. Even if you go to the bank now and you say, I want to buy $1 million in euro, for example, they're going to give you a top of the book and they're going to give you the price. Okay, you can buy this amount with this lot size. You will buy this amount with this lot size. So what we're trying to do in order for us to create, let's say, not the perfect execution, but a viable execution that will be able to be consistent also for the traders and also for the followers, is to diversify it to liquidity providers. And how we basically want to do that is that we want to send flow to the liquidity providers, because the liquidity provider makes money from the flow. You understand? So we need to differentiate it to multiple liquidity providers. And that's what we're going to build upon, and we're going to continue to build upon. I strongly believe from the flow we are doing, sorry to interrupt, because we are doing more than 20 to 30 yards, which is 20 to 30 billion, okay, a week. So you can understand that needs an infrastructure to be correctly, because one mistake can cause a havoc. And this is why we have safety rails for every situation. And in that case, we had a safety rail. So for example, if Dan is going to get in with 600 lots, that 600 lots is going to go to 6 liquidity providers simultaneously. So some slippage may occur, but the bottom line is that it gets less and less and less every time. Nobody's perfect, correct? I mean, I believe you need to build, build, build. So we try to scale this. At the moment, Dan has $2.5 million with a book. I want to emphasize on that. It's not an easy task. I know it sounds easy, but it's not an easy task. However, we make it seem easy, and we want to scale it to $10 million. For us to do any discrepancies, it would be, let's say, dumb, I would like to add, because think about it. Why would I like to do anything wrong with the client that is bringing volume A, and B is making money for us? You understand? So we want to build. We want to build and create a scalable infrastructure, which we are now close to that.
Can I also add, based on what Andreas just mentioned, guys, what he just explained about how the entire process works, it's a case of continuous improvement. When I say continuous improvement, right now it's $2.5 million. Tomorrow, you guys will refer other people, more volume will come in, and the volume will just keep going up and up and up. Eventually, it may reach 100 million, let's say by the end of next year, right? So as the volume goes up, what the dealing team usually would do is obviously onboard more liquidity providers. And this is a case of, addressing the volume as in how it goes up and onboarding more
Well,
LPs, and that's what he's talking about.
And
yeah.
not
So
only
let me
that,
just.
sorry, Chris, just to add, not only that, when you increase volume, your liquidity provider tends to give you better price feeds. So for us, it would be much, much better to increase it from 2.5 million to 10 million, because then we will be able to get better pricing, and also you can get better pricing. I would like to emphasize on that also.
Yeah, and just from my perspective as well, just to add one final thing that people, it's logical, but I guess it's not something you think about when you're trading, because you just expect it to be, kind of flawless. But as we introduce different liquidity providers, they have different pricing as well. So the way the aggregator works is it tries to give us the best pricing available from each one. It doesn't mean that every single liquidity provider is going to give us the same pricing or better pricing during a particular period. Sometimes though, it will be better pricing because like Andrea said, you have positive slippage, and then you also have negative slippage. When there's not enough, you can't fulfill, the liquidity providers can't fulfill that price. So something that people don't realize, and I always compare this to the telecommunications industry. When you are, let's say, a telecommunications company in the UK, let's say, I don't know, can't even think of one, but let's say T-Mobile. Okay, T-Mobile you might be able to get minutes to call China. T-Mobile has to buy a certain amount of minutes for China. So they might buy 10 million minutes, which means they have 10 million minutes worth of Chinese call time. But if let's say the population of mainland Chinese people entering the UK becomes bigger and they're just calling China more, if they can't fulfill the price, they need to go to a secondary pricing, let's say, of the minutes, which might be it's like a second-hand price from China to, I don't know, let's just say Italy, from Italy to the UK. So, they'll get more pricing because you will always get the minutes. It's just that the pricing might change, or the quality of the call might not be as good. And that's why you see, either the reception is bad or just your reception is full, but you still have a bad quality line and you think it's the other person, but they've also got full reception and it's actually the quality of the minutes. So it's very similar in that way, the way the telecommunications industry works, when it comes to pricing feeds for particular instruments.
Yeah, there are many variables. There are many, many variables. I mean, the Asia and the London session, it's mostly illiquid sometimes. So the liquidity is thin. So if someone gets in with a large amount, you can see huge movements. There's many things, but the bottom line here, and the reason we're having this discussion in first place, is that we are here to listen to you, and we're taking that in consideration. And we want to scale it. And it wouldn't be able to scale if we wouldn't be able to listen to you. So what we can tell you for a fact is that we're going to build, build, built. I'm saying that again and again because we need to emphasize nothing was built in a day, correct? But we will be laying our bricks every hour. So having a normal discussion, a dialogue, as I say, we'll be able to create that, let's say, trust, A, and B, to be able to create the infrastructure to get into 10 million, 20 million, 30 million. And for you guys, because you are investors, you are putting your hard work money into this, and we really appreciate that. And I really appreciate the fact that you want to be feeling safe about this. But what I can tell you for a fact, together we'll be able to take it to the next step. Now, regarding the question I see here, because it's very important and I really want to tackle it, can leverage on the account affect different prices? Not different prices, however, it can affect the price at that particular moment when it will close or open. So if I have a leverage of 1 to 500 and my master is 1 to 100, that means you will have 400 more leverage. So the P&L will be affected, not the prices. I would like to emphasize. I hope I answer the question to what you want.
Yeah. Andreas, I have just one more question as well. I think maybe I can ask on behalf of everyone, just based on, you know, my talks with so many people. You know, they do ask this kind of question. When it comes to copy trading, when clients are trading and following, does the price matter when you have more and more followers? Let's say I am a trader, I have 500 followers today, and let's say I feel that everything's going smoothly. Now, it's very common for people to think because there's 10,000 followers now, it's not as smooth. Is that the case, or is this all down to pricing still?
Okay, in this regards, if you can have 1 million followers or 2 million followers, it won't matter. What matters is what equity you have behind of the copy master. Okay, but we need to take in consideration that the technology infrastructure is a technology, correct? So we need to have in consideration that we are connected to multiple liquidity providers, A. B, we have bridge that are connected to these liquidity providers, B. C, we have a third-party provider, which is Brokery, which is a copy trading system. So you can understand we have 3 variables here, that all of these 3 variables need to work accordingly with no downtime in order for us and for you to have a successful trading experience. So it has nothing to do with how many followers are following the client, the copy master in this case. It depends on the equity. It doesn't matter. I mean, nothing will do any cause to it. It's the equity. So if I have, let's say, one client with $1 billion and I have 10,000 clients with $1 billion, it's the same thing. It's the same thing. It's what makes it tick on the back end side. I hope that answers the question, Chris.
Yeah. Sahil, anything from your side?
Yeah, Chris, somebody's asking about why can't you share information on the liquidity providers? Who are the liquidity providers? If you want to just talk a bit about it.
Let me just say this because I know you're recording. Okay, the way I'm going to mention a few, but I'm not allowed to, but I will. The reason why I'm explaining this, just so you understand the sensitivities. What the liquidity providers do not want, because they are a back-end system, if you want to consider it that way. We are the broker. So as a broker, let's say you're not getting the pricing you want or anything like that. Normally what would happen is that you would come to us and you would complain, and we will try and resolve that issue for you, because sometimes you might notice something before we even notice it, right? So it actually does help us when you tell us, to be honest. The issue though is the liquidity provider does not want our clients going directly to them and complaining directly to them. They don't want thousands or hundreds of people doing that because that's not their role. They do not work on the front end. They're not a front office department. They're a back office department, okay? So when we work with liquidity providers, their contracts normally have an NDA in place. Now, I'm going to mention some of the liquidity providers we have, just so you understand that we do work with these liquidity providers. They're not a retail-based company, and they don't expect brokers to mention the name because they just don't want complaints coming their way for, like what happened on Friday when there was a bit of slippage. There was so many people coming to us. It's our job to handle that. So we're fine with people coming to us. We want people to come to us. It also alerts us if there's any particular issues. Sometimes we don't spot things immediately, and nor does any broker, and that's why it's good that we have that sort of relationship. However, the liquidity providers do not want that relationship, okay?
But I would like to emphasize on something, Chris. It's irrelevant to know who our liquidity provider is, because we are connected with the bridge. So some liquidity, let me put it this way, because you mentioned some names. So one LP can get 50 lots, another LP can get 20 lots. So we say we have an aggregation system. So we are connected to the liquidity providers. However, the price feeds and what type of liquidity goes through the aggregation system. So
correct. So in that case, you might not know which one is executing at that exact time.
Yeah, we will be able to know because we see the bridge and we see which flow and which one takes what takes. But yes. Okay, Ken, just to answer your question with can you put 2K with no slippage? It doesn't matter. It doesn't matter if it's $1 or $10,000 or $100,000. It all depends on the execution and what size done will go into the market. But again, you won't be able to see slippage like you did the last time, because when we talked with Dan before the elections, we told him wait until we connect to other liquidity providers, and unfortunately,
well, actually, it was a bit different than that. So when we spoke to Dan, he agreed that he wouldn't trade during the American elections during that particular week, which we were fine with. And then we were working on connecting to Liquidity, a new liquidity provider, specifically for Dan. And he did open up a trade on Friday. Technically, he wasn't trading during the American elections, but that was the American election week, which we expected to be a bit more hefty. And also, just to kind of clarify a bit further to this, just to kind of further mention, let's say, for example, slippage can happen for multiple different reasons. It's not just what Andrea said. It could be that the price feed is just moving so fast that your milliseconds difference between pressing the button and getting the price, or it could be that there's very, very high volatility during an NFP or high news day, and it could be slippage because of the volatility. So it doesn't really matter how much money you put in. Slippage is a normal part of trading, unfortunately. It's not a detrimental part of trading. In other words, what I mean by that is it's not, slippage will not wipe out your account. It's not one of those things that, will completely blow you out or anything. But, there's just certain conditions, certain times of the day that you would be trading that you can expect, let's say, more slippage than normal. And there's also a little bit of slippage throughout the day, which is normal as well, that people don't even notice. Actually, it's so small, people don't even notice it, but it's just a normal part of trading. So slippage, it's just it's always there, even if you don't notice it.
Also, Chris, I mean, for today, most of the clients had positive slippage.
Yeah, there's positive slippage as well. So it can be positive, it can be negative, but it's normally, just dependent on the market conditions. Obviously, on election day, when Trump was winning, gold, when he basically had already won, but it wasn't announced yet. When I think it was after he won Pennsylvania, basically, he had already won. Gold started tanking, Bitcoin started flying, and then US dollar started flying, and other currencies started tanking, and everything started tanking. And during that period, if you were trading, because things were just dropping so fast, and liquidity were actually leaving certain instruments and going into other instruments, there would be slippage during those periods regardless. So slippage is a part of trading. It's something quite normal, but it's not something that's gonna knock you out of the game. You're still going to be in the game. You're still going to be profitable. You're going to be making money in many cases. You might make less in some cases because of slippage. You might make more in some cases because of slippage. It's just a normal part of trading. Is, I guess, the ultimate message what we're trying to explain. When you've got different liquidity providers, different pricing, top of the book, bottom of the book, when you're getting pricing at different parts of the book, let's say, when your equity is growing, how many lots you trade, how much leverage you're using in lots you trade, you know, because of the equity that you have and so on and so forth. All of these factors can cause some slippage, and it's quite normal, especially more so on the A book, which is better anyway. A book is better for large copy traders like IQ Solutions and for yourselves. But you know, you're going to experience slippage. It's quite normal just because there's so many moving factors, so many different LPs, and so many different market conditions that Dan can be traded in, different lot sizes, just so many different reasons. So the point I think Andreas is trying to make is that there are many variables, as he said earlier, to why slippage can occur. It's just that as we start growing our technology and our liquidity providers and so on and so forth, we're doing that to try and limit the slippage as much as possible. And that's why this week, for example, you noticed less slippage than the Friday last week, but it was also an American election week. You know, it's quite a hectic week anyway. The market does take time to settle, and so on and so forth. So, you know, it really depends, and it's just something that can and will always occur.
And also to add, Chris, and because the market's going to open in 2 minutes. By the way, Keith, iPhone, that's a great question. Great question. No, it has not been answered. But to emphasize on Chris, what happened previously, it was an outlier, and you'll be able to see. You won't witness that again, and you would not only witness it, you won't be able to see it on your trading experience going forward. Now,
let's put it. Sorry, let's just put it this way. Go.
Because I need to answer this question, and the market opens in 1 minute. So the percentage we send to our liquidity providers, what we want to do is not to send more than 33%, no more than 33%, because we have the allocation to multiple. So this way we control the risk accordingly. That's a great question, Keith, by the way. Good one, man.
Yeah, and Keith, also, just, you know, the percentages can change. So let's say, for example, as a broker, you've got to remember that, think of it like yourself, right? So as an investor, you might invest in multiple. By the way, Andreas, if you want to drop off, you can. I'll just take it from here, and then we'll finish up.
Okay. Is there any other big questions before? Any other questions? They're all satisfied? That's what I want to know. If it all is satisfied.
I think you've given a good explanation. I think it's a real explanation. There's nothing more we can do about how it works other than do our best to mitigate, you know, and get better, improve the trading conditions as much as possible. But yeah, I mean, feel free to go. I know you've got work to do.
Thank you, guys. Thank you. Lovely speaking to you guys. Well, bye-bye.
Thank you. So, guys, I just wanted to make clear, we don't just have more than one liquidity provider for that reason. The reason why we have more than one liquidity provider is, one, with this technology, the aggregator part of the bridge, it does actually allow us to execute best pricing. So if you remember what we said earlier, the broker is the middleman. So our job is try to get the best trading conditions for the client, so the clients are ultimately happy and they remain trading with us, and we have a more long-term business with those clients. So we're constantly trying to find ways to, you know, improve execution, get better pricing, and just give people a better experience, because that's what makes people stay with us, right? We want a retention. We want to retain our clients, you know, as much as possible by giving them what we can that makes them happy. But at the same time, the same way, think a bit about it when you're a copy follower or an investor, if you want to call yourself that instead. As an investor, you're going to go to a copy trader and you might say, I'm going to put 100% of my money with this guy. And then you think to yourself after some time, actually, do I want to put 100%? I think I want to lower the risk to 50%, just in case he has a bad, or he loses everything, right? Let's say he's going to blow the account. You know, you're a little bit worried about it. So you might move another 50% to another trader just because he's trading a different asset and a different style. And you think, okay, if this one loses, I've still got 50% here, and he's still going to be making me profits as well. And then as you further want to diversify, you might split that to 25, 25, 25, 25, and follow 4 different copy traders. Again, for the same reasons, you want to diversify, you want to manage your risk more effectively, and so on and so on. We also do the same with our liquidity providers. We don't necessarily want to trust 100% of our entire business flow with one liquidity provider, especially if that liquidity provider, let's say they're offset and they're having a bad day for whatever reason, we don't want them to also have 100% control of the execution of our book to all our clients, right? So what we also have leverage to negotiate this way. So if they're not doing a good job, we can put something back on B-Book, or we can put it on a different liquidity provider and say, they're giving me better pricing, you're not, I'm moving my business away from you, you get paid on volumes, I'm not giving you these volumes no more, I'm going to send it somewhere else, I'm not happy with your service. And you know, it gives us bargaining power, it gives us negotiation power. So we're also the same when it comes to liquidity providers. Most brokers have about 3 liquidity providers, if I'm honest with you. Most brokers have 3, some of them only have 1. You know, it's just quite normal for the really, really big companies to have like 1 to 3. But because with us in Monaxa, because we know a lot of very, very high-end institutional traders and very high-end investors as well, as we want to become a little bit more institutional and bring our institutional business in, we were already prepared to onboard more and more liquidity providers. Like I said, we're going to have 9 by probably around February. So, you know, we want to be able to do that because we also want to be able to onboard our institutional investors and clients on a different platform. It's still Monaxa, but it's not the copy trading system. It's a different type of institutional fund management platform that we're also going to be working with. And this is why we were already integrated with like 5 liquidity providers. Then we went to 7, and now we're moving towards 9 as well, just because we are moving in that direction as a company. So just bear in mind, although other companies might have 3 LPs and a very large B book, just remember that if you want a B-Book experience, B-Book can be slightly better in terms of experience than an A-Book, because it's not 100% real conditions in essence, because it's fully controlled by the broker. They can control it a bit more, but we can't control the A-Book, and we can't control the pricing fee. So we still can experience slippage from the pricing feed and stuff like that, but just not as much in the B-Book. But of course, you know, for this type of business, it should be able to, it's more protection for you guys. It guarantees your payment. So in other words, if a broker has you on a B-Book and they don't have enough liquidity to manage such a large portion of funds, including the leverage, because the leverage can make 2.5 million into 50 million, right, with leverage. And if Dan goes all in and puts all his leverage in and he gets 50 million, someone needs to pay that profit. So the good thing is it kind of guarantees the payment from the liquidity provider, and this is why it's important for us to be able to execute on the A-Book. So I just wanted to make that clear to everyone. Eugene said, is there any benefit of trading for any amounts between 1K and 2K? I mean, look, I want you guys to forget the slippage for a moment, because slippage is not the reason why you would trade or not. Slippage is a part of market execution. It's a part of it. You can't change slippage, right? Sometimes it's more, sometimes it's less, sometimes it's positive, sometimes it's negative. You can't change the fact that there is slippage. So when you say, is there any benefit? I want you to forget about that, because that's always been there. Even whether you noticed it before, the slippage has always actually been there. But the benefits to trading with a $1,500 account and $2,000 account is equity. In other words, let's say you're trading, I don't know, gold, and you know the gold drops $5, right? It's done a $5 move. You might have the more equity you have, the more you can resist getting blown out, because as soon as you stop out, the money is gone. Whereas if you can hold it for as long as possible, if you're certain, because you also have to be a good trader to do this, you have to be certain that it's going to turn around. So your drawdown might become very, very huge, but you're swing trading at this point. So what you can do is you can comfortably wait for the market to turn back around with a certain amount of equity. The more equity you have, the more, you know, comfortably you can not worry about the market dropping. Only extreme circumstances can blow a big account. And normally extreme circumstances are things like an American election. It's an extreme circumstance. It happens once every 4 years. It happened during Brexit, when the UK went through Brexit, the day of the referendum results. Of course, You know, there was a lot of turmoil in the markets, especially in Europe. And even the US dollar was affected. And then, you know, let's say the assassination attempt on Donald Trump, let's say when Israel killed the head of Hamas, or he killed the head of Hezbollah, and all these kind of unexpected events, when the Japanese started and the Chinese started selling off American assets like crazy, and we had a Black Monday event that happened. Last time that happened was 1982. So, you know, it's the first time it happened since 1982. It's an outlier event. So these kind of things are the only things you just need to be on top of your fundamentals. The technicals are kind of everyday things, but the fundamentals just keep you prepared just in case. And if you see anything that's abnormal and you're trading for yourself, right? Obviously, you're trusting Dan or IQ Solutions to take these trades for you, and he's performing very well. But if you're trading for yourself, you want to be prepared. Like, you might just go over to your computer and say, I'm not trusting it today. There's these problems happening, and Israel's going crazy, and this is going crazy. I'm going to stop this trade. I'm going to trade again tomorrow. I'll just accept the loss, and I'll recover tomorrow when the conditions are more in my favor, and I can trade as I normally trade, right? So that's how the equity helps you. It's got nothing to do with like slippage or market conditions. Obviously, that will become extreme. Slippage and everything else will become more extreme when an extreme event happens. So the only good thing about equity is that you can survive longer within a trade, and you can bear more risk within a trade without blowing your account. But of course, if you're unclear, you know, it can still blow. If you're not certain that you can survive that trade, then cut it early is the best thing to do, and recover it the next day or when the market settles. And that's all I have. Any other questions, guys, or Sahil, are we good?